The Federal Reserve has slashed interest rates, and the yield on money markets and most savings is down. We're going to look at the best ways to increase your yield on your savings, so stay tuned for more. Thank you for watching. This is Richard with Wisdom Investor. With the Fed lowering interest rates, it's made it difficult on savers. We're going to take a look at the best ways to increase your interest rates on your savings. Here's a headline: what the Fed's shift toward lower rates means for borrowers, savers, markets, and the economy. Well, the good news for the lower rates, if you're buying a house right now, you're going to get rates at probably all-time lows or near all-time lows. Or if you're refinancing your house, you're going to get an excellent interest rate to drop your payment cost. Now, the negative parts of this, if you're a saver, maybe you're retired and you want to get the most interest on your money so that your money can last the rest of your lifetime, it's not so good news. We're going to take a look at a way to increase rates without increasing the risk level dramatically. Let's first look at Treasury yields here. So we're looking at the 3-month Treasury bill, then it goes all the way to the 30-year. And this column here is the yield. 3-month Treasuries, 0.1%. Pretty low, pretty low. If we go out 2 years, not a whole lot better, 0.12. 10 years, 0.62. 30 years, 1.33. With those Treasury yields being so low, it's made it difficult for money market funds if you like to keep your money in a money market. For example, Vanguard Money Market Prime here, the rate on this at this time is 0.04%. That's pretty low. Here's some various CD rates going from 1 to 3 years. The best rate found online here was paying right around 1%, dropping down to 0.6%. 2-year, 1.15, not a whole lot better than the 1 year. And then if we look at the 3-year rate, that's around 1.25. So we're going to take a look at some ways to increase the interest and yield on your savings or money that you have sitting in the bank that is generating a low interest rate. We're going to start with the funds that earn the least amount of interest and work higher. We're going to start with our first of 3 categories. Now, this category are short-term bond funds that could be used to replace your money market fund. Keep in mind, we said the money market fund was earning about 0.1% or less. So this first fund here I have is a short-term bond fund. It's Vanguard Short-Term Federal. It has a yield of 0.81% and a duration of 2.2 years. What I like about the Vanguard Short-Term Federal is that it's invest in AAA quality investments, 93.14%, primarily government and U.S. Treasury, so it's high quality. Now with bond funds, including short-term bond funds, you can have some principal fluctuation. So what we want to do is look at the duration here. So short-term federal here, Vanguard, has a 2.2 year duration. If interest rates went up 1%, this fund would change by 2.2%. So if you had $100,000 invested, if interest rates went up, the overall fund would go down by 2%. Keep in mind, if it went up 1%, you would also be earning close to 2%. So as bonds move down, interest rates move up. But this is very little fluctuation, and the federal government or the Federal Reserve has said they want to keep the rates as low as possible. The next fund that I like is the double line low duration. It has an interest rate of 1.97% yield, and its duration is 1%. So that means a $100,000 investment, if interest rates went up by 1%, the overall principal would go down by $1,000, but again, the interest rate would probably be closer to 3%. Now let's take a look at how the double line low duration is invested. AAA is 50.91. It does have some triple B in it, primarily government, a little bit of corporate bonds. So double line is also a pretty safe investment. Now let's look at these two and see how they fluctuate in price. If we take a look at the Vanguard short term here, you can see the principal amount has continued to grow as interest rates have gone higher. We did get a little fluctuation here when stocks dipped in March. Just about everything fluctuated, but this went from 10.8 to 10.7, and that's a very little change. Now we're taking a look at the double line here, and we did have a pretty good dip here because it did have some corporate bonds in it when we had that market crash. Now in reality it's not that much. 9.9 at the top came down to 9.2. This did drop a few percentage points, but you can see under normal conditions it's pretty steady. But since the drop, it has come back and back to where it was, but it's overall a pretty steady fund. The third one on this list is iShares Ginnie Mae Bond ETF, yielding about 1.35%, and it has a duration of 1.1 years. We're looking at the market fluctuation on the Ginnie Mae. You can see it's pretty steady. During the March collapse in the stocks, it did come down some, a couple of percent maybe, and then it has bounced back, but it's under normal circumstances, it's pretty steady fund. Our second category funds are primarily going to be Ginnie Mae funds, but Vanguard Ginnie Mae yielding 1.35%, 1.6 years duration. Fidelity Mortgage Securities 1.35% with a 0.05 years duration, and T. Rowe Price Ginnie Mae Fund 1.55% with 1.4 years duration. Now, our third category here is taking a little bit more risk to earn a little bit higher yield. Fidelity Floating Rate Fund, the yield 4.5%, and then the Osterweiss Strategic Income Invest in Small Company Debt has a yield of 5.71% and a yield of 1.8 years. The main risk on bond funds at this point would be if interest rates went higher, then bonds can start to move lower. But the Federal Reserve is going to do everything they can, at least over the next few years, to keep rates as low as possible. Now, one thing that could change that is if we get into some massive inflation, the market conditions could change and interest rates could move higher. Therefore, the principal of bonds could move lower. Thank you for watching.